All right, and here we are. Welcome to Stake Mondays, guys. My name is Mirko, CEO and co-founder of Stake Awards, and today we are honored to host the famous Julien Bouteloup on the show. Julien has been a blockchain and crypto investor, serial entrepreneur, DeFi builder since 2011. He's founder of Stake Capital, Stake DAO. He's in the core team at Curve, the top stablecoin AM, founder of BlackPool, a DAO focused on NFTs. He's the creator of the first ever flash loan. And finally, also the founder of Rekt.news. Julien supports the constant innovation of the crypto sector and is passionately supporting like a lot of DeFi builders in the industry. So it's an honor to have you on the show. Welcome to Staking Mondays.
Yeah, thank you, Mirko. Thank you for the nice introduction, and thank you for the show. Yeah,
awesome.
Thank you for having me.
Yeah, it's a pleasure to have you on. We can jump into some short form questions here. Just answer very briefly from your side. What gave you the crypto bug and convinced you to make it your life's work? You started in 2011, which is obviously a long time ago. Yeah.
Yeah, I think my introduction or my involvement in the crypto space, or more broadly in a blockchain space, was more like a mistake, or more like I mean, you can call it a chance. Then something that I investigated really deeply. Back then, the industry was not talking about blockchain, and being in blockchain in the early days in 2011, 12, or 13, even before 15, was mostly considered as a bad virus than a good virus. So I got myself into the blockchain industry because of my experience and my background in decentralized systems. But even decentralized system back then was not anything related to blockchain. It was more like streaming, torrents, the capacity to do like stuff on the cloud, and being able to stream content. So it was really something associated to bad activity on the internet, and with the increasing movement of the music industry and the movie industry, that was really something that people try to or tend to not talk about. And this is that direction that brought me into the blockchain industry, and particularly in a Bitcoin thing, where I became a Bitcoin BTC maximalist, because there was only this before Ethereum. And then an event, a meetup in London. People from the Bitcoin industry they were making fun of experimentation like Ethereum in the early 2015, and there was a meetup there. So I went there and then I listened. The intention for me was just to have fun, because we didn't really believe in alternative than Bitcoin. And then I realized that actually the initiative was pretty powerful, and the people there, they were really legit.
Awesome. Yeah, that's super exciting. A lot of the super early adopters really come from the technical perspective. And yeah, I mean, we've come a long way since then, obviously. Like looking at the industry today, like what is an under the radar crypto project that you are very excited about right now?
Yeah, I mean, my background is really mathematics. I got a background in mathematics and physics, and obviously, as a French person involved in mathematics, you usually end up in quantitative algorithmic trading world. So I started working in this area, and then so the project that I'm mostly looking at the moment is really about derivatives, products that are sufficiently complex in the traditional market, that are coming into the decentralized, the DeFi space. Because most of the products that we currently have access to or using in the DeFi space are products that are copied and brought into the DeFi environment. The only difference is the protocol or the technology, the underlying technology that is different. In the traditional finance, you will have market making, but not automated market making, but you will still have lending market that are using a different stack of technology, but it's exactly the same in a decentralized finance. So I truly believe that because the space is getting more mature and more traditional players are jumping into the space, that now we are ready and the space is ready to welcome a complex product such as swaps, debts, bonds, and all the different things. This will drive the next wave of adoptions, not necessarily from the retail space, but more from the traditional world.
So like when you look at the industry today, like what is one subsector, like it's probably like you mentioned a lot about DeFi, right? Like bonds, derivatives, and so on. Like what is one subsector where you think like we've made a massive progress within crypto, but it hasn't really gained any traction on the real world yet in the mass market? Like which subsector would that be?
I think the thing that we've seen over the past this past year, the NFT craziness. It was the same. What happened with the ICO space, building landing page and creating crazy projects, raising a lot of money, but having no substantial value to the ecosystem. Only 1% then created value, but 99% disappeared, or they all left the money. Well, we saw the same in the NFT market. The NFT market was driven by people trying to flip assets and make a lot of money very quickly using JPEG projects, but without any value. Well, now the space has changed. So people, as 2017 in the ICO craziness, they cannot create just a landing page and raise a crazy amount of money. Well, it's the same with the NFT market. The NFT market is really huge now, and people are creating product every single day. So to differentiate yourself is very complicated. So what you have to do, you have to create true utility. And this is exactly what we're moving into. And by creating true utility, you have projects from the traditional finance that are finally seeing the opportunity and seeing the potential of such technology for them to leverage their existing business model. So for example, like TikTok, Twitter, projects that have an utility business that are providing value to people. But now if they use NFT, for example, like trying to avoid bots spamming or giving access to people to a specific tool and products, for example, through the metaverse, not in the metaverse as the Meta, Facebook kind of worldish kind of thing that they brought to the market, but more like something that has pragmatic value and correct incentives in such a way that they can leverage the blockchain technology for them to increase their market share of the society.
Awesome.
So I believe, so I believe like those projects, TikTok, Messenger, Telegram, all those applications that are more like retail industry.
Yeah, 100% agreed. And I can't wait for that. Hopefully it will be decentralized and not just like the naming Meta and so on. But yeah, so like what would be one simple advice for you for someone who got into crypto like just recently in the last 12 months and he's still here, like because now the market changed a lot, like just very briefly, what would you tell them as like an advice?
Yeah, I think I would say that to anyone that just joined the market or is in the current market, but experiencing the first bear market or the first crash. If you stick to the value proposition of what blockchain can bring to you or to society, I think it's a reasonable assumption that long or staying for the long term it will bring you more value than trying to trade the volatility of the uncertainty of what's happening. Because in any market, you always have players and you have people that are known to play the rules very nice, very strongly, but also manipulate the market. So if you are in a side that don't understand that you have people that are manipulating the market and are trying to use your weakness of either not understanding how things work or the weakness of you trying to make money, most money in short term, then you will get wrecked. So I would say that you stick to the value proposition, you stick to the what this industry is trying to bring, which is transparency, decentralization, and more importantly, the ability for anyone to build anything without asking asking permissions to anyone, and whatever you are in the world, without borders. And this assumption that this space is built on mathematics, going against the principle of how society is built, which is axiom 1 + 1 = 2, and at the end, going against it is very bad and will mean that you get wrecked. So that's why, like, I would suggest that you build, ship, and if you can, economically speaking, stay long, because sometimes you have some uncertainty and you need money, then you can exit your position, then it's fine. But in this space, what I would do is like get a work in the space, generate money, and then long the industry.
Thanks. Very well said, Julien. And like in that context, like, why do you think staking is important for the industry? Like you are involved a lot with staking, we are as well. So why is that important?
That's actually how we met first in the industry. Remember the time of Cosmos and staking, and we were involved again. That was very funny because when we first met and you were jumping into this industry, you also understood the space. I mean, the early days of the space, and most of the people outside, they were criticizing and they were saying Cosmos or live peer or Ethereum staking or whatever will never make sense. Like Avalanche and all those different protocols, we have to remember that in the early days, 99% of the industry, of the ecosystem, didn't believe in it, and we were criticized to operate such a business. I remember a lot of people left because of the bear market, and they were providing staking as a service. The early days, how we met is because you guys were providing a service for Tezos. Also, we were involved. So I would say that now it's very clear that staking, if it's correctly and with the value of the sharing the same core values of this ecosystem, then it has to be decentralized. And in the staking industry, the way that you can decentralize blockchain is by staking, or the early days of blockchain is by mining. If you have people in the world that can have access to either unlimited capital or free energy, which is very unlikely. So then you have a centralization of power in the mining industry. In the proof of stake, in the staking industry, the idea is to allow anyone in the world to be able to participate in the validation of a protocol without having the necessity, without being forced to either have access to free energy or unlimited amount of capital. The amount of capital, people would say, yeah, but in order to have a huge power or to have reasonable amount of power in the staking industry, you need to have capital. Well, the thing is, like, you can actually capture capital because you can build platform and project that will aggregate tokens that you can use to provide validation, for providing validation on the blockchain. So the staking as a service or the staking industry, either on the protocol level or on the project level, like we're saying with curved walls, if it's correctly built and correctly operated, meaning that you have a lot of different actors that are not sharing mutual incentives or mutual interest, then you can call a protocol or a project decentralized, because each of those parties will try to satisfy their own market share, but each of those market share are competitors with each other. So it's very unlikely that people will either bribe themselves to either fork on the protocol level of blockchain or on the project level, redirect the inflation for their own benefits. That's why staking in the industry of blockchain is the biggest pillar of maintaining the vision of Satoshi Nakamoto, because this is the only way by staking that you're providing validations and you can actually operate different projects.
Yeah. I mean, it's amazing how like just everyone can contribute to the security of their investment by just running a node and contributing to it. It's a fascinating concept. Cool. So just last short form question here, like what do you do to get away from the chaos in the crypto markets? Like obviously the last months and years have been pretty wild. What do you do for fun?
I think if you build projects, maintain a huge team of people, and yeah, trying to build project and ship them, you don't really have time to see the chaos in the industry. But if your main goal is to make quick and short money as a quick grab in the industry, then it might be painful. That's the reason why it depends on your values. But if your value is to provide to capture value from the industry and also provide value from the industry, you better work in the industry, either create a project or join an existing project that is sharing the echo of this industry. So then you will make revenue, income that can sustain yourself during those period of time where it's not necessarily really clear that we are aiming for a bull run for the moon.
All right. Yeah. Cool. And what do you do like usually to like if you want to get away from it? Do you have some hobbies? Or
No,
like...
I'm a workaholic. I'm not saying this because it's usually people they say that because it sounds good, but I work a lot and I try to I code. I do coding a lot, so I either just get myself in a room and try to find a new idea and trying to ship
Awesome.
it, or
Yeah.
trying to meet people. But I also like trying to get outside, play sport, for example, go running or stuff like that.
Awesome. Yeah, really cool. And I think we all see that from the dedication you put into it and all the projects and everything. So stay with us, guys. Today we'll talk about the impact of the Terra crash. We talk about algorithmic stablecoins. We talk about the future of DeFi governance. We talk about the alternative layer one space with its Ethereum. We talk about staking beyond proof of stake, how to not get wrecked, and obviously about Stake DAO and the big vision there. So let's start with a big hot topic recently, which is Terra. Like Terra's implosion had like clearly set back the industry quite a bit in terms of like trust and so on. And we now have like the old Terra and the Terra 2.0, which launched over the last weekend here actually. What's your take on that? And do you think either like the old Terra or the new Terra network they have a future, or why not, you think?
I mean, without entering into the details of either Terra 1 or Terra 2, the difference between them and if there is a difference, my only concern is in the early days of Terra and also the design mechanism of Terra. If you check my tweets, if you check some people in the industry, we were very concerned about having a stablecoin that the existence of this stablecoin, the only way to maintain it was by having the exact same mechanism as the SEC or the Fed, basically printing money out of nowhere in order to sustain the craziness of such an API. The fact that people were jumping into it because of the API was really high without understanding the technical aspect of such a project was really concerning to me in the early days. For example, I operate a quant and a fund, and the goal was not to touch it, because the problem if a project is based on a non-existence, there's no mathematical background behind it except printing money out of the air. So that was the principle of Anchor. You could then provide your liquidity and then receive money that was freshly printed out of nowhere, not even collateralized. So you have different types of stable coins, and obviously myself as being part of the early the team of Curve in the early days with Michael that created the project, the vision. We understand really we understand the stablecoin market because we're the first one to build an auto market maker for the stablecoin market, and we have a risk assessment and we have all the different things. The only issue with such a stablecoin is it's not directed by maths. It's directed by believing that people will constantly buy, because if you are buying, then as long as you can sell the buy that you have, you will always make money. And that's the danger of it. My only concern now today is how can some people originally in such a project have huge amount of liquidity and investment in the early days of Terra, and can today say, like 2 weeks ago, that yes, it was a Ponzi and it was not well architectured because the way it was built cannot go forward, but at the same time are financing the reborn of such a project that current early days they were making a lot of money. They were not criticizing it. They were incentivizing people to buy. They were basically selling the drug to people for them to buy. And now that they got wrecked, they basically, a week ago, they were complaining about this product, and they're now technically speaking on the space saying, yeah, this is true. This was the best product. But now last weekend, they were making a reborn of the project with the same design, meaning that if they agreed that the project was bad, why rebuilding it with the same base pillars and still selling it to the retail? I mean, that's only my concern. And I think in this space, and now you can see all these people, influencers, they were first selling the project, then they said this was bad design, and today they are supporting the project in the same way it was operating before. Why? Because some people, they need to remake the money they lost. That's it.
Yeah, no, that's a good point. It probably goes back to what you mentioned earlier. Like there are two types of people in the industry: the long-term believers and builders, and opportunistic people who are in it for the money. And I think there was a meme on Twitter where someone pulled out a sheep and like it jumped, and it just jumped right into like the line again, which is Terra 2. So they make the same mistakes again. Which is interesting. But so do you think like under collateralized algorithmic stablecoins can work, or they have a viable future? Or do you think like the DAI model is like fully over collateralized stablecoins? That's the future, or is there any option for algorithmic stablecoins?
Yeah, I mean, I'm investor in one of the new projects, so obviously what I say can be interpreted as being objective. But for example, as I mentioned before, I'm really into derivatives. I'm really into complex products that are complex, but without not transparency. Meaning, I'm not into the subprime crisis where loan and credits were offered for nothing. Here, I'm talking about mathematics. Well, I like it, for example, in the protocol of Angle, they are in these experimentations or this protocol, they're really trying to bring traditional finance, but not the aspect of printing free money, like for example Terra UST, but more with the derivatives attached to it. For example, the futures. So here, what they're trying to do, they're trying to maintain the peg by having agent, having people agent that can buy. People that will basically purchase, will take a future, will take a leverage long on a certain position, and for here, like on the dollar against the euro, because they are building a stablecoin euro. And I like this concept because this concept is really like mathematics, and it's not. So with having such a stablecoin, you can have under-collateralized stablecoin, and being able to mint more than the collateral you have in custody or in smart contract in a DeFi space, because you are using derivatives, you're using futures or options or products that will try to maintain the peg, but at the same time with by having under collateralized assets.
Awesome. Very interesting. I mean, what's funny to me is like when you look at like the current traditional finance, the banks, like that would probably like collapse very badly as well if everyone had a bank run and like try to withdraw their money from the bank accounts. So obviously the system is not stable, and I think it's clear for everyone. I'm not sure. But what do you think can we learn from that? Like, is it just too big to fail? And what can we do better as well? Like, if we look at traditional finance and like, not to repeat the same mistakes again as we like further build the DeFi space.
I think what I like in the blockchain space is everyone can actually verify the accuracy of a statement if the project is fully on chain. So, for example, I'm not talking about custodial stablecoins such as USDC, USDT, or other custodial stablecoin, because these again are based on the assumptions that you trust the authority or the emitter of such a stablecoin, because no one has access to the liquidity or the asset that is being put in behind USDT. You just have to trust the entity that is saying such that yes, we have more asset collateralized than the asset that we issued. For example, that's the reason why they got fined by the SEC, because they don't have access to the thing behind it. So in what was the question again?
The question is like, what can we learn from like the traditional finance? Where basically like there would be like a major collapse if there would be a bank run, which was the same that happened with Terra, but somehow it just doesn't happen in traditional finance because it's too big to fail.
Well, it does happen. Yeah. It does happen a lot. I mean, the subprimes, 2007, 2008, when the financial system were giving credits, were giving mortgage for almost free, and actually completely free, under collateralized zero asset, because their incentive was they were getting paid by the number of accounts they were opening rather than the number of accounts they were legitimate to open. And that's a difference. So there they are a lot, and then a lot of banks collapse, and they have a lot of bank run. So coming back to the stablecoin or this industry where you can transparently, in a transparent way, verify the accuracy of statement. So not USDT or USDC, but for example, initiative like Curve, Auto Market Maker, Angle, Aave, all those different protocols you can verify. And the problem is in the DeFi space is like when people are trying to mix financial concept of non-transparency in the DeFi space, or same behavior as the financial industry of minting free money from nowhere and mixing this in the DeFi space. So the lesson that we can learn is, as long as you provide a system that can be fully audited, is fully transparent, meaning that everything is on chain, and normally, and also like based on mathematics and not on the concept that people will buy because it's good. For example, like because it's like a marketing good. So what I heard a lot in Twitter space is like, no, this is good because the APY is high. I mean, there's no such thing as a free lunch, meaning that if the APY is high, I'm not talking about crypto assets. Crypto asset, the APY can be high because the pool, the impairment loss, the pool doing a lot of trading volume. So if it's crypto, then it's fine. If it's a stable coin that is giving you a lot of APY, for example, 20 or 30%, there's two ways of doing it. Either you're printing free money from nowhere, this is dangerous, or you're incentivizing the pool with the governance tokens, which is safe. So at the end, you might not receive the APY that was mentioned, but you will not lose your underlying asset if the underlying asset is based on mathematics and is based on transparency. So the thing that we can learn from traditional finance is that you need to focus on mathematics and you need to focus on transparency and security.
Awesome. Yeah, that's a great take. And talking about stablecoins, like the biggest stablecoins today are like USDT, USDC, DAI, and then a few others, but there are very little Euro stablecoins actually. You support some like Euro stablecoins on Stake DAO as well, but why do you think is it that like only USD stablecoins have gained major traction, like significant traction in the market, and like no Euro stablecoin or any other like alternative currency yet?
I think it's not actually true that no momentum on the Euro stablecoin. I think the Euro, for example, DAI was created in the early days of Ethereum, and what made DeFi or decentralized finance and the pumping up of those many different projects that actually DAI. It's MakerDAO, because at some point people were able to build projects without being exposed to the volatility of a speculative asset, but more about the stable coin. So it took to the industry almost like 6 years, 5 years to build a stablecoin dollar, which was a DAI, and then we had seen other initiatives such as USDC, USDT. So dollars was the first one to be created, and we can say that Euro is only 2 years old. So we have Statis, and we have other initiatives such as Angle protocol, as I mentioned. I think first, legal reasons. I think in the US, it's probably at the moment more a friendly ecosystem for building a dollar that will support the vision of the United States of pushing for inflation, being able to sell inflation to other countries such as Europe or Asia. So that's in a huge market. And also the fact that in uncertainty and war, as we've seen lately, the dollar is always gaining some traction against other money. So, for example, at the moment, dollar euro, always in a time of uncertainty and macroeconomically risk, dollar is performing better. So at the moment, it's a little bit risky to invest in euro, even if euro lost a lot against the dollar. But yeah, I think it's more about markets, macroeconomy. The moment, if you checking how price are being settled in the world, it's always in the US dollars. And I think the euro and the fact that I would like to see European, the European Commission or the monetary system in Europe pushing for euro stablecoin, because this will bring back sovereignty against other nations outside of Europe, and also inside of in each country of the European zone against Asia and United States. So yeah, I think it's more regulation. You can build project outside of Europe that is more friendly, and Euro at the moment is a little bit septic, the Eurozone on the crypto money and blockchain. But with initiative like Angle or Statis, especially Angle because of the mathematical aspect of the project, I believe now they have more than 200 million US dollars. And if you look at the progression of DAI, that's always like to see, like if you see the progression of DAI in the market cap of how big was the market cap before, and then other stablecoin, I would say that other stablecoin are actually progressing slowly, less faster than DAI in the early days, because that was a small market cap, but managed somehow to gain a huge, for example, 1 billion in the early days, and then they lost the competition a little bit against competitors. But now in the euro space, it's the same. If you compare to the European market, then it's pretty big, the European stablecoin. We'll see with all those derivative projects, like being able to short or long. So as soon as we enter in the FX market, so thanks to Curve, for example, with the Chinese coin as well, Chinese economy tokenized asset, entering this market, we will see more volume. So for example, if you build CNY, US dollars, euro pool, then you will need to have huge volume inside. I mean, you cannot depeg the pool, so you will see a lot of volume in euro. It will push people to lock asset or to mint asset based on mathematical formulas.
Yeah, and like talking about Curve, which is obviously like the biggest player in the stablecoin market, and the Terra incident, because UST was also like a major stablecoin. Like how has the death of UST actually affected Curve, and like what Curve is building? Like, does it have any long-term effects on Curve? Like, are there any takeaways or anything in the Curve team, you think?
No, because well, first it was in the early days, so we had to get the pool there, the asset. The pools on Curve, it's not like a project like Balancer or something. Each pool in Curve is isolated, so the scope of the risk is associated to a pool and doesn't actually impact the other pool of liquidity. If the pool dies, there's no risk for the other pools because the assets are isolated to the single pool. So it's actually a risk for the assets that are inside this pool, because by leaving the pool with the asset that is over collateralized compared to the one that is decreasing, such as USDT, then you are actually leaving with penalty. But there's no risk for the rest of the protocol, if that's a question.
Right. Yeah. So it's just a
investing inside the pool, you expose yourself to the risk of the asset inside the pool, not outside.
Yeah. Yeah. And so like the whole Terra incident was quite interesting because like it really shown to light like some deficits in the governance system in Terra as well. And like until they halted delegation, because it was kind of very easy to take over the network because a lot of tokens were printed in a very, very short amount of time, and someone could have attacked the attacked the network by just acquiring a lot of tokens for very cheap. And that goes back to like the thing about proof of stake is like it's very much like in terms of governance. If we say there's one token, one vote, it's very similar to like traditional companies, how they are structured as well in terms of their shares. And this is something like Lynn Iden also pointed out lately, that it's really comparable to traditional in terms of governance, comparable to traditional companies, opposed to like proof of work, where you get the basically externalities to contribute to the governance and are the miners and so on. Do you see that as a problem in general? And do you have any other takes on that?
Well, the question is like, do I see like centralization of power of governance token in this proof of stake a danger?
Yeah, I mean, do you see it as a problem that we have this concept of like one token is one vote, and basically you need to like acquire a lot of tokens to contribute? So it's a centralization issue basically. Yeah.
Of course, like remember back in the days we were, I mean, for example, we're like one of the major validator on Loom network. It was in the early days of this industry. And then there was like other players. As soon as Binance jumped into the validations, then the protocol died. But I mean, there was also a different aspect. But basically, Binance had incentivized people to stake into the protocol. We're paying people to stake into the protocol, and they had major validations. And the protocol became fully centralized. And that's funny because then sometimes it's better to have a protocol that is owned by the core. So being a project, some people are like, oh, but the project is owned by the team and is controlled by the team. So I'm like, yeah, it's much better than having 2 or 3 entities outside that are controlling the protocol without having the incentives that every day they need to work on the protocol and wake up each morning to build the vision of the protocol. So it's always better to have people that are fully committed to the vision and will do everything possible to build in order to make the success of the protocol than having entities and other people outside the project that are driving, or economically speaking or technically speaking, being able to manipulate the protocol. Because for them, they have no incentive sometimes for the product to have a long-term vision, because short-term they can make huge profit and then invest in a different other project. So the centralization of power in proof of stake is really difficult, because proof of stake is the accumulation of governance tokens that can give you one vote. But obviously, if it's one vote to vote and validate and earn the incentive of the protocol, but also making decisions for the future of the protocol, like for example, Uniswap is having a lot of problem with the VC and people behind it, because those VCs and those people that have major stakes inside the protocol are not actually aligned with the success of what the team and the core team is trying to build, or the retail trying to use the product. So it's complicated to find a mechanism that is mixing economic incentive, but also a good tokenomics or game theory. For example, some people have been thinking about, and that's what we try to do in Curve. For example, like the fact that you have one token doesn't give you one vote. If you lock those one token for 4 years, then give you one vote. But if you lock them for a fourth of a year, then you get a fourth of the voting power. That's a mechanism that are actually giving you, still, if you have a lot of capital, but you don't believe in the vision of the project, you will lock for 1 week, where someone that has 4 times less capital, but believe in the vision by locking 4 times less capital than a whale, will have the exact same voting power. So you can actually make a 4 times. So what, by doing this, linearly speaking or exponentially speaking or logarithmic speaking, you can do is like by having less capital, by getting more engaged with the protocol for the long-term future of the success of the project, then you have more voting power than someone that is economically incentivized to short the project short term, to make money short term, and short the project to make money short term. That's interesting. Is like, how can you build tokenomics that are sufficiently solid, to incentivize good behavior? They can be people that are engaged with the project, people that are building in a project, or people that are trusting the project in the long-term future.
Yeah, it's a fascinating concept, and it also shows that like in staking and proof of stake, the design space is basically endless. So it doesn't need to be one token, one vote. And you also like you launched the liquid lockers at Stake DAO. Like what do you think does the future of staking and DeFi look like in the coming years? Like, is it like in Gitcoin we have like the delegate model, or like one token, one vote, or like governance rights could be tied to like other contributors of the ecosystem as well? Like, how do you think does it look like? And maybe you can also expand a little bit like how the liquid lockers in Stake DAO work in that concept.
Yeah. So back in 2017 or 18, I think I made a few tweets talking about the concept of governance token having more power than money. And people from the industry, they were, you're saying shit, this is not possible. Money is money, and money has always more power. People that control money control power. But in society, we can see that it's completely different. It's not because you have money that necessarily have the voting power or the sufficient lobby to be able to control voting decisions for huge impact in society. So I'm talking about the Parliament, the European Commission, for example, in the model of Europe. People that are there, they're not actually control of the country. They're not control of the European zone. People are controlling them indirectly at the lobbying. Lobbying that, for example, a car manufacturer and the car industry is saying, okay, if you don't want to push the number of cars in this country to be adopted by your people being sold to the market, then we cut the job. We cut the job by 50,000 people in the north of this country. And then by doing so, you will become so unpopular that the next election of the country will hate you. So what you see is, what you see is like, what do we see is like the concept of lobbying being more powerful than money. And in DeFi space, I'm not saying this is good or not, but what I was saying like 5 years ago, 4 years ago, and also like I initiated and created the concept of curve walls. I was basically talking that by having voting power, it will become more powerful by having money. And money in this term of auto market maker or lending is liquidity. You might have a lot of liquidity, 10 million US dollars. But if you have 10 million US dollars worth of curve and you lock them for 4 years, it will be 7 times or 10 times more powerful than having 10 million US dollars. Why? Because you can redirect the inflation of the project into certain area. So the money that you get for this is actually more valuable than having 10 million useless liquidity. And that's important. And the space, unfortunately, move into this concept of pushing for more centralized power of governance, meaning like bribing. It doesn't matter if you're good or bad in the industry. And if you're actually bad and have money, you lock them, and the power you will be able to solve it for the people that are not providing value to the protocol. And that's what we actually see in, for example, in Curve, and that's the concept of curve walls, is the accumulation of governance power that not necessarily incentivized for the success of the protocol, and also for the people providing utility or value to the protocol, but more for their bag and for the people that are using their product. So what you do, you build project on top of a major protocol, and each project is not necessarily is just trying to make big money for their users, but not actually sharing the echoes of decentralizations and also success of what the protocol is providing on the basement. And that's dangerous, and that's the reason why in Stake DAO liquid lockers, what we did is we provide the exact same features that a project will provide, meaning boosting, increasing the APY by locking this asset for very long term, for unlimited amount of time, still giving them the chance to exit the position. So that's why we call it liquid, because you're locked, but you can exit your position, sometimes with a small penalty, because the underlying asset, which we call the principal, is generating revenue for the long term, the bearing token. And you still have the bribing mechanism and the boost, but then you keep the voting power, you keep the governance power of your assets. And then what we're trying to push for is, and we did, is you will vote for the decisions of the protocol. So liquid lockers are built to decentralize the industry rather than trying to build a giant centralized power that will just do everything possible to either go against decentralization, transparency. And that's what we call in the GAFA, like Google, Facebook, Twitter, like all the different people in the industry that are making money from advertising, money on the behalf of people, and not actually redistributing the value to people that are providing value, because for them, they're making more money. And that's what we're trying to avoid in the industry of blockchain, trying to focus on decentralization, transparency, and redistributing value to people that are providing value to those projects.
Yeah, that's amazing. And especially like when everything is fully transparent, it's auditable, it's verifiable, then everyone has the ability to fully understand it and also participate. And you just have some layer to abstract the complexity there a bit, which is great, I think. And then, so going back to the Terra incident, and like in relation to like proof of stake, it's kind of interesting to see like how well Tendermint worked in like all the turbulences of that incident, basically. And it definitely speaks for the innovations like of Tendermint and like proof of stake in general, and also innovations from the Cosmos ecosystem. What is your take on the future of alternative layer ones, and how will a multi-chain world look like? Like, are there going to be like just a few ecosystems like whatever Ethereum, Cosmos, or like some other big contenders, or like many winning ecosystems, or will everything ultimately be built on Ethereum, you think?
Yeah, I think that's a good question. Been there in the Cosmos industry in the early days. And that's probably the reason why I have this vehicles. It was really tough. We provide validation for 2 years, and it was in an industry where there was no market for tokens. We didn't get money, and it was like we were building the way, the game theory behind those different mechanisms that will support the next generation of blockchain or current one. I think certain blockchains are built or certain tools, for example, like Tendermint or the hub and the mechanism of this, built to empower a project, but not necessarily provide value to the protocol. So it's not because you have a lot of projects that are building in the Cosmos environment and attending the Mint protocol that the value will go to the Atom token, for example, because it's actually not correlated. You can the Atom project, the Cosmos project is a project as another project, Osmosis, or as another project. So they have no correlation between each other. Where the Ethereum and other blockchain like Avalanche, Polkadot, Tezos, and stuff like that, the asset that is enabling people to build on top of the protocol is used by those projects to be. I mean, those projects, they need to use it. So there's a direct correlation and correlation between the success of this asset and the number of projects that are building on top of it. At the moment, the Ethereum, obviously I was, after the become maximalist, became an Ethereum maximalist. And then after like a couple years ago, become more like a vision maximalist of this space, and more supporting any project that is building value and providing value to the ecosystem without necessarily looking at the technology. That's the reason why I support any protocols that is based on mathematics and providing value back to the ecosystem. Having said that, it's quite complicated to see major other blockchain being able to compete directly with Ethereum in a long-term play, because also if Ethereum become proof of stake friendly and being able to send transaction as a cheap cost and also send many transactions, so having a super fast chain, then a lot of projects will be incentivized to stay on the chain that has the biggest liquidity and the biggest project. And at the moment is Ethereum. So what you see is a fragmentation. Now it was a fragmentation of the blockchain industry into the capitalism of being able to capture more market shares, because Ethereum is lacking on speed, super expensive. Saying to the retail industry that you need to use Ethereum, it's kind of like lying to the retail industry, because except if you have 10,000 or 20,000 or even $50,000 in the bank account, then you can use Ethereum. Otherwise, paying for $50 or $100 transaction cost, then it's kind of it's a joke. It's a joke. That's the reason why other blockchain now, for the past 2 years, they've been able to capture value, because they provide something that Ethereum was not able to provide. The reason for that is because being already live on the market for almost 8 years, 5, 6, 7 years, more than 7 years, and then moving a proof of stake to proof of work to proof of stake is difficult. But the research side has been created and mostly research and based for on Ethereum based. So the long term, I think you will have blockchain that will be specific to a certain need. For example, if you want privacy, or if you want a cheap transaction, I mean, all those different things will be possible on Ethereum. You will have like sidechain, you will have layer 2 solutions, you have like a different solution that provide you one way or another of the triangle: speed, transparency, security, anonymity, and privacy. And then you have other chain that's the reason why they all bring in bridges, is because maybe they will do a deal or partner with a certain project that will be only available on the blockchain. And the reason why those blockchain will, I think you had the fragmentation of the blockchain industry into multiple different projects. And now that we're moving into utility and more like maturity of those projects, we're getting into a consolidation. So you'll see in the near future, many different blockchains that will disappear. And then it will be structured as top five blockchains that will be used on the retail side without knowing that you are using them. Because that's what I call the layer 3. Is being able to use blockchain without knowing you're using blockchain, but also the product that you're using is actually using multiple blockchain. For example, for now we have DEX aggregator. You also have DEX. You also have aggregator of DEX aggregators, for example, CowSwap, that are managing the liquidity, that providing the best quote for the best swap and the best route on the same protocol. But you will see soon, being for them to, if you have fast bridge, being for them to use the bridge without knowing you're using a bridge. So the DEX aggregator will be able to do a large swap across multiple different blockchains. But then for you, it will just be Euro, dollar, ETH, BTC, or other assets. And then that's the reason why I think the consolidation of the blockchain will exist, and you will see multiple blockchains, because on the retail side, you will never see that you're interacting with those blockchains.
Right. Yeah. So it has to work seamlessly together, like the top 5, in order to cater to the different use cases. Yeah. It's kind of fascinating to look at it from like calling it layer 3. It's same for, like in staking as well. Like staking is a fascinating concept. Like you can contribute work, validation, and security to the network, and basically like earn rewards for doing that, like directly contributing. And there's also a lot of abstraction happening for it. So we have liquid staking coming up, and there are tokens like derivatives where you can kind of circumvent like the lockup periods of the native staking, and Like, how do you think will staking look like from an end user perspective? And like, let's say in 5 years or something, will everything be liquid staking? Will like the whole lockup periods and will everything be abstracted away as well? Same as you just mentioned for the general blockchain space.
Yeah, so for, I mean, it's a subject that I really like because I actually create the concept of liquid staking. It's a document that I think I issued in 2018, maybe a little bit later. So liquid staking, and then right after people executed the visions such as Lido, for example. So I work on different projects to provide liquid staking in the industry back then when there was only live peer, for example. So I think the concept of staking assets and being able to unlock specific features such as voting governance power or having fully liquid positions will be completely transparent, seamless to the retail industry. The retail industry, at the end of the day, what they want is to use a product that giving them utility. If you're using a product that the product is telling you to lock this specific asset, to buy this specific asset to be able to use it, it's a little bit odd. It's like saying, I want to use TikTok, I want to use Twitter, but at the same time, you need to buy the Twitter share, you need to lock it, and then you'll be able. At the end, what they want is like, okay, I have this profile, I've been providing that much of value of Twitter to Twitter, then I unlock this level of gamification or this level of accreditation in Twitter. For example, the blue tick, I unlock it because I have that amount of followers, and then I'm giving this NFT. But at the end of the day, you don't need to know that actually this profile that you have is accumulating Twitter governance tokens, is also based on this NFT that you can unlock specific features. And then if you want to open a gym membership, that NFT might be used to this Twitter NFT mechanism might be used to open a gym membership because Twitter has sufficient accreditation or sufficient way of proving that you are unique and also that you've been providing value to the industry. So I think at the end, it's like it will be completely transparent for the user. So those concept of those projects, but what the beauty of it for the vision of those projects and the vision of the industry, each of those projects, and also yourself without knowing, you'll be participating in the staking industry. Your phone will be validating on a certain chain, a period of time per day if you turn on your phone. And also those projects, in order to be decentralized and not exposed to the risk of using a third-party provider, such as Infura on the RPC mechanism to communicate with the blockchain, you'll be running a light node or you're running a full node, depending on the evolution of the technology across those layer 1 and layer 2, if it's cheap or not expensive, but you'll be doing this by default.
Yeah, it's a very interesting thing that you mentioned, like running a node on your phone. So you think with like all the abstraction happening around staking, like how can protocols like Ethereum, for example, like it's very important that there is a culture around running your own node in order to like foster decentralization and really have a decentralized network. So you think in the future there is a way like that like someone could just run a validator node on their phone? Do you think that's something feasible for the future, or like how do you stand there? Like or will like the whole validation services be more centralized and the abstraction will happen on the end user side?
Yeah, I think if we agree that the vision is decentralization in the space of the blockchain industry and also society, I think we need to have people to be able to run those validations and those blockchain without knowing they are running them. So each of those projects being able to either run a light node. The goal is not to consume the energy of the earth. The goal is to being able to have a technology that is strong enough for it to run without consuming much energy, but at the same time decentralizing the protocol level of how transaction and data is being operated worldwide.
Yeah. All right. And so what do you think, like talking about like staking in the DeFi world, what is the biggest value proposition for staking right now outside of proof of stake? Like there's the concept of like reward distribution, like tying it to governance rights, labor markets, like all of this stuff. Like where do you think is the future of staking in the DeFi space, kind of? Because this concept is obviously being explored way more right now.
Well, I mean, staking is not necessarily staking on the protocol level. Staking, as we saw it in the DeFi space, you stake asset to either increase your APY, to boost your APY, or to unlock specific features. We also are seeing staking on the NFT side, where, for example, we built in Stake DAO the first strategy that is, if you have an NFT and you stake the NFT inside the strategy, first you unlock the fact that you can enter the strategy and you can provide liquidity. So we have both. We have providing staking on the NFT level and staking on the asset that you provide in order to capture yield in the ecosystem. So staking is just a traditional financial product where you say, okay, I have some assets and I'm willing to give those assets to for short, medium, or long term inside the protocol. So it will provide value to the protocol because obviously you decrease the inflation or you increase the consolidation of the asset that you have, and then at the same time they give you access to something else. So in the traditional finance, you can see them as VIP membership or like stuff that you unlock because you have certain asset and you lock them for a specific amount of time, like points, smiles, and all different things. In a more blockchain industry, staking is providing decentralization, is providing security of the protocol you're using, and on the product level, it's actually trying to bring more features for you as a staker inside the protocol. So I do believe that staking in any project that is built in the industry, you have the concept of locking the asset in order to capture the inflation, in order to capture the rewards, and etc. And also those projects will also provide staking on behalf of those protocols.
Yeah. Oh, that's amazing. And obviously you've already experimented like greatly with like NFT staking, for example, as well, which is a very interesting concept as well.
Yeah, because staking NFT, people believe this is JPEG. Yeah, it's JPEG, like the ICO world when we saw a landing page and bullshit project, but then then it got Uniswap, Curve, and Aave, and all the different things. It's the same as the boom of the internet phase, where in the 80s and 90s, there were like tons of projects, but only 1% made it because the rest they were either a scam or not well executed ideas. And we're seeing the same in the industry, like NFTs. I truly believe that's the reason why we have. I built BlackPool. BlackPool is a hedge fund or fund that is primarily and 100% actually primarily uniquely operating in the NFT space. Not that because we believe in JPEG, but because we believe in the technology of the NFT. NFT is a non-fungible asset, and in the traditional finance, in the traditional world, in finance, you have debts, bonds, and swaps, and all the derivative products that need either non-fungible asset or a good understanding of mathematics. That's the reason why NFT are the frontier of mathematics, from non-fungibility, and also the traditional aspect that can unlock real estate, arts, music, movies, industry, like all different things. So it's a huge market that for now we only seen the marketing side of it, but we're now entering in the finance aspect of it.
Yeah. That's a great point. So definitely NFTs overexplored as JPEGs, underexplored as the technology for what it is. Yeah. So
it's always if you look at it's always the same. Yeah, it's always the same. It's always the marketing and the influencer driving the trend because they're using it as a bullshit kind of like mechanism, most of it, except if 1% is always super unique. For example, Bored Apes at the beginning they had this idea of private club and all different things, but it became this, and now it's like super important and super useful. But yeah, always the case.
Yeah, and that's great if people actually create utility with it as well.
Yeah, exactly.
So if you look at the crypto and DeFi space, like what's another thing you think is like massively underexplored right now? I know like there's a lot of talks right now about soulbound tokens as well, and it seems like crypto always has like these narratives, like hype cycles, kind of. What do you think is one sector that will surprise people in the coming year or two?
Yeah, I think one of the hype, still being every single year. Even myself, I got into it like in the early days. I mean, there was the hype of the vision of identity framework, identity sovereignty aspect, and I built a project called ID Box. I think that was the first project in the Ethereum. Physical project, like being able to make transaction, was deployed in Papua New Guinea, won the United Nations, all these fun things. I think the identity concept is a huge concept, but not in the identity that, for example, Elon Musk mentioned on Twitter, where you can track and identify people uniquely. In the sense of being able to doing surveillance. I think the identity framework really we really have to think of outside the box, how we build identity in a blockchain space. If you're saying that the identity is like something that what China is trying to build, where you push for mass surveillance and being able to dictate who can access what because of their credit score, they cannot take the plane because they are the bad bad borrowing rate or whatever. This is not actually blockchain. What blockchain wants to build. Blockchain wants to be. You want to be able to provide services to people that can identify themselves as being unique, but at the same time, you don't know who's behind that identity. And that's really the concept and the vision of blockchain. Is like, and what's I call avatar. An avatar that can give special accreditation or special permissions to a service that is trying to identify you. For example, if you want to apply to a membership at the gym, why do you need to give your passport and the location of your house and also the bank account number and all different things? Meaning that someone that is inside this gym will have access to full identification of yourself. And we know that black market is easy, and you can sell those passports, you can sell those accreditation to people that can create fake license for driving a car and all different bullshit. So the beauty of blockchain is being able to decentralize the economy, decentralize and having more transparency. But at the same time, we need to push for privacy and anonymity, and also being able to uniquely identify someone, but not someone as a person behind it, but as someone that has accreditation to use that specific service. And that's the beauty of it. But I think regulation will need to think about. We need to think about this concept about being able to send transaction anonymously, being able to send stuff without knowing what is behind. But what I want is like more regulation to be able, for example, to track people that are doing bad activity in the industry. And I think this is possible by having system like NFTs, identities, system that, for example, if regulation wants to know what's behind this transaction, then you receive a transaction request, and you can give authorization to have access to this specific information. And this NFT avatar can unlock the potential of such information. And that's the beauty of it, is you focus on privacy, but if someone wants to verify and has authority to verify the information, you give permission. If you refuse to give permission, then you might be actually doing something bad. That's the beauty of it. And I think that the identity system in the industry of blockchain is fascinating, it's hype. I don't see anyone that has all the projects that I've seen in the past that all said we build an identity framework. They all failed, or because they were badly executed, or just made them just to make money. But for now, there's no one that actually provided a system that can actually provide an identity framework for society.
Perfect. So you're also the founder of Rekt.news, where basically anonymous writers can whistleblow intricacies of the DeFi space, and you kind of track the biggest exploits in the industry. What's the most common pattern of projects that you have seen, and how to spot that early, and how can people avoid getting wrecked in crypto?
Yeah, I think the success of Rekt is also like the amazing team behind it. Great team. We are operating in a darkness. It's an underground activity. So Rekt is made for the industry, and I would say something that people might smile, but it is built by the people and for the people. And I think that's the only project in the industry that is actually providing free informations. I mean, I'm talking about analysis, auditing, and trying to explain to the space how this project got exploited, and also the visions of what we're trying to build. Because we have also videos, Opium Diaries, Dystopian Dreams, and Ape Tags, and we try to have kind of like
amazing videos, by the way. Anyone who didn't saw these videos, go check it out. We'll also put it in the comment in the YouTube description. Yeah.
Without being too yeah, I would say this is probably the best video that you'll see in this ecosystem. We spend a huge amount of time. It's homemade. It's house. So everything you see is like it's design and design inside in house. The way we do is like we have a team that will analyze the market. Will analyze everything that is being deployed or being used by the ecosystem. But we also receive a lot of messages because now we became pretty big and pretty strong in the ecosystem. And then we try to explain the exploit or explain what's going on with certain actors in the industry in a way that people can understand, but without missing the technical side and analysis, because Rekt is built in a way that will provide value to people. We'll always try to have an agnostic or objective analysis of the thing. That's the reason why we always analyze blockchain transactions and not necessarily trust people that are telling us something. And the one of the Rekt that we saw that was biggest, the most easy one is obviously trying to manipulate the Oracle system. So most of the project in the industry, they base the assumption that outside data that they are gathering for the good behaviors or the good functioning of their project it will never get rate or will never change. Well, the thing is like people that either manipulate this Oracle price to mint a normal amount of assets that they can then use to deposit inside the lending market somewhere and then borrow capital. But if the asset you're depositing is worth nothing because it was printed from nowhere, the asset you're getting is actually free money. And even if after you get liquidity, because you get liquidity on an asset that had no value, that's the beauty of it. So I think the Oracle way of manipulating projects is the most well-known one. And got raked a lot of different people manipulating the price of the pool, manipulating the Oracle price. It's all the kind of same things. And then you have like more complex way of DeFi Lego and manipulating one project, casculating to another project. So I think that the beauty of those projects is how you can manipulate one, but not necessarily steal money from this one, but use it as a tool, as a Trojan horse inside another project. And I think this is really beautiful. In order for you to not get wrecked, there are 2-3 different keys. I would say tools that you can like features. First, always put money in project that you either know the people behind and you have trust, and people that have been in this industry for quite some time. If they're not, because you need to come from somewhere. If they are new comer in this industry, then focus on security, auditing. Always trust that they have been audited. Also verify that the audits that they're providing is actually real. But if you invest, and then if you invest in a project that you don't know the people behind, those people have not been in the industry for quite some time, because trust is everything in this industry. If they are known and not audited, I will not trust such a project, because this project is based on verify and don't trust. If the project is built by people you believe, and they have been in the industry for quite some time, and their reputation is worth more than the value they're providing inside the product, then it's the product I will go for, because then the reputation is worth more. And for them, if they get wrecked, then they lose reputation. It's very bad. And then third is, security plus people behind it, plus the project is acknowledged or used by other projects, then use it. But if you're using a product that is not audited, that is built by Anon, just for the sake of getting high APY, I think, this is not legal opinion or something, but I think if you get wrecked, don't get frustrated, and might be a reason that you got wrecked, and it's maybe you deserve it, because The problem is like chasing high APY in the industry. If you get high APY, it means that someone is losing money. And at the end, if you're losing money, it was part of the game.
Yeah. Nothing as a free lunch, as you said earlier.
Nothing is a free lunch.
Yeah, cool. And then probably like also like just check the oracles. Is there a way to like reliably check the oracles that they are not so easily getting manipulated? Or
well, the code is open source, but in order to verify that the oracle cannot be hugely manipulated, then it's pretty difficult. If you know 100% sure that the oracle cannot be manipulated, it means that you also know how to read smart contract and how to read bugs. So you might be entitled to a bug bounty and make money. So it's very unlikely. I would say that 0.001% of this industry know how to read code. So what you need is like either rely on people that are running the project, rely on the team, and rely on. So I wouldn't say like you need. It's verified, don't trust. And for people that are not technical, they can do the verification in order for them to trust the project by having people running the project that they understand. They will take the reputation on their behalf, and also by the auditing firm that provide the information for them to not get wrecked. So the verification process for someone that is non-technical, and that's, as mentioned, is in terms of proportions, there is no one technical in the industry, in number of people that are using the DeFi space. So you need to rely on project of people building project that have been here for sufficient amount of time for you to understand that there's no risk behind it.
Awesome. Yeah. And like, how do you think can crypto become more secure without being fully regulated? Like, I mean, you mentioned like that there's always a trust component. Like what can protocols do, or what can the industry, what can we do to make crypto more secure overall without going into regulation?
Well, you have initiative in the space that are, for example, bug bounties platform that are incentivizing people to find bugs, and then they will reward them for a lot of money. So if you have a bug bounty attached to a protocol for a bug bounty of 3 million, for example, I think in some product you have 10 million US dollars. For example, on Solana wormhole, you have a bug bounty of 10 million US dollars on the protocol attached to it. So the more money you have attached to this protocol, to this project, the more likely the project is safe. It's the same with using. We forgot completely about the risk of using Ethereum and Bitcoin because now some people enter the industry as assumption that those protocols are just normal product and they are safe. The reason why they are safe is because the bug bounty attached to them is so huge that if there was a bug, then it's very likely that someone, not very likely, but it's more probability speaking, more likely that someone will have found it. If you have a protocol, for example, Bitcoin market cap of 1 trillion US dollars, then if no one has found a bug yet, then it means that this protocol is one of the safest protocol on earth, even more safer than a custody and a safe in a bank or in any other protocols on earth, because the bug bounty is decentralized, the code is open source, accessible by all, and audited by all. And the bug bounty is so huge that if you hack it, then you can make a huge amount of money. That's the reason. The more money as a bug bounty is attached to a protocol, and the longer the protocol has been operating in the market, the more likely the protocol is safe. That's the reason you can increase. I don't think you can increase security by having more regulation in a sense of protocol level. You can increase security by people not getting phishing attacks or exploited on email, fake wallets, fake private key. Yes, on the protocol level, you need initiatives such as bounties, marketplaces, and different things like that. And auditing firms, obviously. Yeah, auditing firms, obviously. But the point is, like, auditing firms is good for the product, but auditing doesn't mean that the product is 100% secure, you know?
Yeah, that makes sense. Cool. So, and then like talking about Stake DAO again. So Stake DAO is like one of the largest staking DAOs, and there's a lot of innovation coming out of the Stake DAO ecosystem. You are like a yield aggregator. You have the liquid lockers. You have like the NFT staking, like a lot of stuff. Like what will the world look like in 5 years once Stake DAO is like wildly successful? What's the big vision for Stake DAO?
Yeah, I think it's a good question. We have one side of Stake DAO that is trying to be the major leader in the meta governance, meaning that we want this space to be fully decentralized and providing value to the ecosystem without losing yield for people. So that's one side. The Stake DAO is providing a tool, a feature for this industry to be able to use those different products of DeFi, be successful, but at the same time, keep the decentralization aspect that the vision of blockchain is giving us and trying to push for. And then at the same time, in Stake DAO, so we also have strategies where you provide strategy in the ecosystem that will give you the best APY rewards, either on the lending market, on the auto market making mechanism, or like different products such as the stablecoin industry with Angle or Frax. And also because of our background, traditional finance, and a lot of people, also quants inside the team, we understand the traditional finance. So we understand how derivatives work, how options, futures, and all different things. So we are building projects, we are building tools that can give people APY or rewards, but in the exotic product or in a complex financial world. And this is something that we're giving. So I think the success of Stake DAO will be very niche, vertical, one that you want to be active in the meta governance and also provide yield and having access to yield on the different assets without even thinking about it, without understanding the complexity of the protocol, without understanding all the different mechanisms that are used in the governance space in order to create those yields. And that's one aspect. And then still operate in the complexity of finance, providing products to people that are so simple for them to use that they don't need actually to understand what's going on. And then obviously for the part of the fund, we're also building a layer of gamifications like the NFT, the points for people that are not in DeFi, they don't understand it, but they want to be on the marketing side. They want to be on a Twitter user, TikTok, Instagrams, and they still want to have a foot inside this industry. And this is like a layer that we're also providing. So we'll try to make Stake DAO way more simpler and isolating those niche of products for people to understand them very easily without actually the need for to be able to analyze and understand the security and the technical aspect of being able to provide those yield and those products.
Yeah, the abstraction of the yield is a great thing, and it should help a lot of people. So do you have any like exciting new product releases coming up or anything you can share already for the next few months? Or like how does your roadmap look like?
Yeah, I think we have liquid lockers. Liquid lockers are built for meta governance. So we are constantly, I think we are the first one to provide such a mechanism in the industry of DeFi. So we'll be pushing them for cross layers, bridges, and all different things. We also provide new mechanisms that might be copied from the traditional finance way to be able to provide value to to make rewards, money from those different products, but at the same time keep the value proposition of the blockchain industry, which is decentralization and transparency. That's something we're trying to push for in liquid lockers. And obviously on the other vertical derivatives, we are building on the option side and releasing something new. And also like for people that want to hedge or leverage themselves on this ecosystem, particularly when the market is going down and being a little bit risky, then you want to offer people the ability to be data neutral, being not exposed to the volatility or the exposition of the bull or the bear market, but still constantly making rewards on the assets. This is something that we are really good at building, and this is something that we still want to build.
That's amazing. So that was the last. We have one last question, but yeah, thank you so much for being on the show. It was great. A lot of insights today. Thank you so much for everything that you're doing in the industry and everything. It's amazing how many projects you're involved with, and Stake DAO is definitely going places. Can you share with like someone who's just listening to the episode and like really liking the stuff that you're building, like how can someone get involved and participate and also follow you and like the latest developments and everything, and just get involved and contribute?
Yeah, sure. Sure thing. I think if you follow me on Twitter, my Twitter space is open. So I'm not the kind of person that will ignore or try to. If I don't answer, it's because I have a lot of different messages being coming, but I always end up answering everyone. So message me on Twitter, ask question there. Also, if you want to learn about this industry and you're just new into this industry, I highly invite you to go to Stake DAO Academy, BlackPool Academy, where we have built a school. And again, this is free content, like Rekt.news, fully free. And the reason we can provide those contents because actually we never get paid. We never receive any money from anyone. The content that we provide is fully objective and provide value to the customer. So the Academy of Stake DAO, and also obviously staking rewards, because you want to earn about all different products, staking mechanism. And also you guys are providing good content for the retail space, trying to explain each of those protocols, how they are functioning, where did they derive the APY and all the inflation rate and all different things. So I think this is very good. So if you're new, go to Staking Rewards, go to Stake DAO Academy, BlackPool School. We also have labs. And I think if you read this content, spend like a week reading this content. If you read the entire content of Stake DAO that is written for retail first, without the need or without the understanding of technical aspect of blockchain, you will understand a good amount of information in order for you to enter this DeFi space without putting yourself at risk. And again, don't trust, always verify, and always run your own analysis before joining a project. Don't listen to someone telling you to join a project without actually understanding what you're doing, or without putting the trust to someone you trust that will do the reputation level for you.
Awesome. That was some very good, great last words here. Thank you so much. And for everyone watching, hit the like button, hit the subscribe button. We have more great episodes coming, and make sure to check out our previous episodes of Staking Mondays as well. For Julien and for you guys, and my name is Mirko. As always, happy staking.